One group of restaurant stocks that so far has been healthier for investors is the dine-in category, stocks like Brinker and Darden. So how should investors make sense of this growing divergence in the categories? Let's bring in Bernstein senior research analyst Danilo Gargiulo. Danilo, good to see you. So interesting, the Chipotle CEO squarely said, hey, look, economic times are tough. The working class consumer, I'm paraphrasing here, is drifting toward these deals. Is that a normalization, or is this somehow like a tougher time that's going to get alleviated? Because, I mean, hey, the markets are doing pretty well, but that's not necessarily helping the working class person.
Yeah, John, first of all, good to see you. Secondly, I would say you were talking about this divergence between the fast casuals and, the full service restaurants. And I think, to your point, there is an element of pricing that might be potentially impacting how people are perceiving full service restaurants and casual diners as opposed to even the fast casuals as of today. Specifically, for about $20, you can go out and potentially sit down in a place and have your meal served to you. And right now, if you're in central Manhattan, for $20, you probably can get a bowl. And I'm not talking specifically about Chipotle or Sweetgreen, but in general, the fast casual have been taking some price, and now some consumers are starting to be shifting back their experiences into the restaurants in a full service space. So there could be two other reasons. Go ahead, I'm sorry.
No, I just wanted to follow up on that. So which, though, is normal? Is it normal that people enjoy the fast casuals and they're going to go back to them after there's more certainty? Or was the anomaly that people had gone away from those more affordable options in the first place?
Yeah, and this is exactly the second point that I wanted to mention. So if you look at the casual dining in the past 2 years versus the fast casual has taken less price versus the quick service restaurant. They have accumulated some incremental spending and traffic from consumers. And so there was a little bit of an incremental consumer going into these fast casual places. Now you're starting to see a normalization of the trends, right? You're starting to see consumers realizing that even going out in a full dining setting may not be as expensive as we started to see places like Chili's or even Olive Garden bring back some of the value and the value for money on the table.
So listening to you, Danilo, and looking at the earnings that we just got, including from Brinker today, the takeaway to me is that the consumer is still leaning into value, but what's considered value has changed. And it sounds like fast casual, at least in terms of prices, has gotten so high that it's now competing with some of these dine-in options, and the value therein lies with the restaurants.
Well, I would say that the dynamic also will extend to the quick service restaurants. I mean, your comment is extremely valid, and I would extend to the entire restaurant sector because even the quick service restaurants have taken even more price than the fast casual. So what we are seeing today is a little bit of the lower income consumer of the higher income consumer of the quick service restaurants are now trading up a little bit into the fast casual. So at least this has happened also last year because they realized that for $1 or $2 extra, they can be going for Chipotle and having a bigger meal, so bigger value for money. But at the same time, because the pressure is happening in the low-income consumer and we're starting to see some consumers fading away in the entire sector, that kind of upgrade is not sufficient to be bringing the entire restaurant demand up. And so on a net basis, the consumer is now under more pressure. And so with the disposable income coming down, everybody's seeing an outflow in the total consumer.